Welcome to the Financial Planning Certification Exam Lessons podcast. This is going to be a sample lesson of the full series of audio lessons which are available at the website fplessons.com. That means financialplanninglessons.com, fplessons.com. At the website, you can find the full series of audio lessons. The full series of audio lessons consists of 6 different sections. Those sections include general financial planning principles, professional conduct and regulation, insurance planning and insurance products, investment planning, tax planning, retirement, savings and income planning, and finally estate planning. A total of 6 different sections. You can buy the individual sections at the website fplessons.com. All right, let's get on to this sample lesson. This is audio lessons for the Financial Planning Certification Exam. This is Part 3, Investment Planning, and this is lesson number 1. In this lesson, we are going to be talking primarily about the taxation of fixed income investments, including money market funds. And over the next few lessons, we are going to be going into much detail about fixed income investments, including government bonds, corporate bonds, and municipal bonds. But I just wanted to cover quickly in this lesson the types of government investments that your clients may be interested in, and we're going to be covering them in more detail later on. But let's just first of all talk about what I consider the primary short-term investments for my clients, and that would be treasury bills. Now, there was a long period of time, probably about 10 years, when you earned virtually no money or very, very little money on fixed income investments, short-term fixed income investments, including treasury bills. But as I am narrating this particular lesson, we have finally seen interest rates rise to a point where it makes sense to invest in short-term investments again. As I write today, I was able to buy a 6-month treasury yielding 5.44%. Treasury bill it was. So let's talk about treasury bills. Treasury bills are issued at a discount to maturity. They mature at par, and you buy the bills at a discount to par. And they're issued in maturities of 4, 13, 26, and 52 weeks. Theoretically, you can buy as little as $100 in a treasury bill, but you'd have to do that directly with the treasury account. Most brokerage firms will not let you buy less than $1,000 in treasury bills. While the minimum may be $1,000, the maximum is usually several $1,000,000. I'm looking at the screen right now and I see a short-term treasury bill with a minimum investment of $3 million and a maximum investment of $15 million. That's just one. I see another one here on the screen with a minimum of $1,000 or one bond and a maximum of 6,864 bonds or $6,864,000. So if you're going through a brokerage firm, you're going to be looking at their inventory and what is available at what maturity and interest rate. Treasury bills are considered risk-free as far as principal goes. You cannot guarantee the purchasing power of any fixed income investments, but at least with treasuries, you can guarantee that the principal will be paid, as long as the government doesn't go out of business. Treasury bills are not subject to the original issue discount rules. So for instance, let's say you buy a treasury bill at 95 and it matures at 100. Or in other words, 95% of par and matures at 100% of par. So you paid $950 for it and it matures at $1,000. That $50 is assumed to be interest, not a capital gain. Direct treasuries are taxed at the federal level, but not at the state level. So the interest earned on direct treasuries such as bills, notes, or bonds, is taxed at the federal level on your federal tax return, but is excluded from income on your state tax return. Let's say you buy a treasury bill at 95 and you decide to sell it a week later and you get 96 for it. So you got $10. That $10 would be subject to capital gains. In other words, short-term capital gains. And in bills, it's always going to be short-term because they're less than a year. Now, let's say you bought that same treasury bill at 95 and you sold it a week later at 94 and you lost $10. That $10 would be considered a short-term capital loss. So it's interesting that they say if you hold the bond to maturity, that's considered interest income. But if you sell it prior to maturity, that's a capital gain or capital loss. I don't know that it's going to make much difference. Most of your clients, when they buy treasury bills, are holding them to maturity. But if they do need to sell them, it's a liquid market, and they would be subject to the taxation as if it were a capital asset. The next short-term investment we're going to be talking about is commercial paper. Commercial paper is issued by highly rated corporations for short-term financing. It's typically issued in denominations of $100,000 or more. Maturities range from 1 to 270 days for commercial paper. Commercial paper is often backed by lines of credit from different banks. They are fairly secure. However, I have often seen that direct treasury bills, which are a safer investment than commercial paper, offers a higher yield. So when I'm talking to my clients about short-term investments, I look at the yield curve, and if commercial paper is not paying higher than treasury bills, I always go directly to treasuries or treasury bills. Usually bills, because I'm looking at short-term investments as a general rule. Unless I want to go out for longer-term investments in treasuries. And then again, same thing occurs. When I'm looking at longer-term treasuries, quite often I will see higher yields on direct treasuries than on corporate bonds, highly rated corporate bonds. For instance, I'm going to pull up a yield curve right now in front of me. So I see a one-year treasury, direct treasury, is yielding 5.328%, and a AAA rated corporate bond, which is a lower rating than a direct treasury, is yielding only 5.049%. So why would I go with a AAA corporate when I can get a higher yield on a U.S. Treasury, a direct U.S. Treasury? To get higher than a 5.328% at this particular time, I have to go down to a single A rated corporate, which is yielding 5.811%. So that's just an example from the real world while I'm creating this lesson. Another possibility for your client for short-term investments would be certificates of deposits. As long as they buy them from separate entities and don't put more than $100,000 into any one CD, they would be usually eligible for FDIC insurance. There will be more on this later on. There are both negotiable CDs, in other words, CDs that you can sell in the open market, and non-negotiable CDs, where you basically have to hold the CD or take a substantial penalty for early withdrawal. Let's talk about the taxation on CDs. Interest income is taxed at ordinary income rates. For federal and state, there is no state exclusion in CDs. And if you sell a CD at a premium, in other words, more than you paid for it, that would be taxed at capital gains rates. And vice versa, if you sell it at a loss, that would also be a capital gains loss. Let's talk about taxation a little more on CDs. Let's say you buy a 2-year CD and it does not pay interest until the end of the maturity. So you don't get any income prior to maturity. The interest would be taxed in the year you earn it, so it would be taxed in the second year at maturity. An investment I have seen used occasionally for planning for children's future needs, such as college, is the use of treasury strips or zero coupon bonds. These are bonds, longer-term bonds that you buy at a discount and they mature at par. So for instance, you might buy a bond that matures at 20 years. During that 20-year period of time, you're not going to collect any coupon. However, you would buy it at a significant discount, and that interest would be imputed in the purchasing price. So for instance, you might buy a 20-year zero coupon bond at 50, in other words, $500, 50% of par, and it would mature at par, or $1,000. So that $500 would be the interest that you earned over that 20-year period of time. It allows you to put a small amount in now, and it grows to be a significant amount later on. You don't buy these through the Treasury Department, you buy strips through broker-dealers or financial institutions. The big disadvantage of a Treasury strip or a zero coupon bond is you must impute the interest on an annual basis. In other words, even though you don't earn any income from the bond, you have to assume you did earn income because time has passed and the bond has become more valuable. Now you could calculate the interest using a financial calculator, which is the likely way you're going to need to impute the interest earned on a zero coupon bond. So for this reason, sometimes it doesn't make sense to buy a zero coupon bond in anything but something like a deferred tax account, like a retirement plan. Otherwise, you're complicating your tax return. All right, so for example, on a zero coupon bond, how would you calculate the implied or imputed interest on an annual basis? Well, first of all, using your financial calculator, you could take the example I gave. You bought the zero coupon bond at $500 and it matures at $1,000 or par in 20 years. If you throw that into a financial calculator, that gives you a compound yield of 3.5265%, or just say 3.5% to keep it simple. So for year one, you would take that $500, multiply it by 3.5% times 1 year, and that would give you the imputed interest for that year that you need to include on your tax return. In year two, you would take that $500, multiply it by the 3.5%, and then multiply that by 2 for 2 years, and that would be the imputed interest for the year two. For year three, it would be the same formula, $500 times 3.5% times 3 for 3 years, and so forth and so forth. So it can get fairly complicated. For that reason, I tend to avoid buying zero coupon bonds outside of a tax-deferred account. All right, let's talk about the other bonds that your client may buy, and these can be bought directly from the government. Series EE bonds. These bonds were issued after May 1st, 2005, and they carry a fixed interest rate. They're issued at face value, and you can buy any denomination from $25 up to $10,000. They must be held for at least 12 months, and there is a 3-month interest penalty if they are redeemed within 5 years of purchase. The interest grows tax deferred and is payable when the bond matures. However, if it is desired, you can recognize the income earlier. They are not subject to state income tax. The advantage of Series EE bonds are they can be excluded from gross income if it is used for higher education funding. But there's some caveats. The bonds have to be issued after 1989. It's for qualified higher education expenses at eligible institutions. The bond purchaser must be at least 24 years old, and the bonds must be registered in the parent's name of the student. There is a phase out, and the modified adjusted gross income must be below the phase out, which is updated annually. All right, that's going to cover this short lesson. In the next few lessons, we're going to get into the nitty-gritty of money markets, government bonds, corporate bonds, and municipal bonds. If you already understand these topics, you may want to skip over them, but we need to cover it because you may be tested on them. Best of luck in your studies.